So let's put a bit more meat on the bone around Class 1 then, which is the most paid of all of the national insurance contribution classes in the UK, predominantly because it's paid by employees and also by employers. So employees above the age of 16 up until state pension age will pay this. That is known as primary Class 1, and employers will pay that on secondary Class 1 on the wages that they pay to their employees. All of this is generally settled through PAYE without the need for anybody to engage through self-assessment for it. The possible exception to that is the company directors, who are technically employed by their companies that they run. So therefore they pay Class 1, and they can pay this on an annual basis rather than through PAYE in certain circumstances. So that's possibly the exception to the rule there. It's important for you to recognise that company directors are employees. You know, we went through this with income tax, where we made sure we clarified that self-employed is businesses that essentially there's no distinction between them and their businesses. That's sole traders and partners. That's the self-employed. And company directors that run firms are technically employees, so they'll pay Class 1. So it's an important point to make on that regard. So let's look at Class 1 in a bit more detail on the rates it's paid for and how much it's paid for on the next slide. So we'll commence our journey through the National Insurance Contribution section by looking at the primary Class 1, which is essentially what we pay as employees. And we need to start paying this as soon as we acquire age 16 up until the state pension age. And basically this is going to give us credits for the state pension. So every year that we pay what we're meant to pay in national insurance contributions, we essentially get a stamp in a record book. And we collect these stamps when we've paid the right amount of NICs based on our individual circumstances throughout our working career. And we need 10 stamps, so 10 years of record, before we are entitled essentially to get any state pension at all. Should be easily achievable for most people that live and work in the UK for their lives. And you get a proportionate amount if you get between 10 and 35 years. In other words, it's prorated. But if when you come to state pension age, you've got 35 years of records in your book, then essentially you're going to get the full state pension in your own right. So it's quite an important contribution, this is, obviously giving you this entitlement, and it also gives you entitlement to other state benefits, and certain other state benefits rely on your NIC record effectively to be paid to you. So just to reiterate that then, up to 10 years, nothing, 10 years to 35, a pro rata, 35 years or more, then effectively you get full state pension in your own right. Now, the payment of primary Class 1 is essentially for those that have earnings over the primary threshold. And you can see the primary threshold shown on this particular slide here. And it changes generally most years. And once you hit this level, then you will start paying national insurance contributions from your wages, essentially. And there's also a lower earnings limit, which sits below that. Again, this is shown on the slide in front of us now. And this is essentially the threshold for which you start to get credit. So what we need to understand with this is that if you have earnings below the lower earnings limit, then you'll get no credit for having paid NICs and you won't pay anything. If you are in between the lower earnings limit and the primary threshold, then you will not actually physically pay any national insurance contributions. However, you will receive a stamp in your book. And if you're over the primary threshold, then you will pay NICs based on your income above the primary threshold, and essentially you will get a credit in your book for the correct amount having been paid. So yeah, it's quite a useful thing to understand this, and obviously we build our entitlement throughout our lives. Employers also pay national insurance contributions, as we've already alluded to. Secondary Class 1 for their employees. So essentially all relevant employees are in scope. There's a couple of exceptions here that you do not need to actually pay employer NICs for. That is essentially those employees that are under the age of 21, extended to the age of 25 if you have them on a registered apprenticeship. So this can cause a bit of confusion here. This is purely secondary class 1 that you get these exceptions for. If you're employed, you're an employee, you're 18 years old, you're paying it, whether you're on apprenticeship or not. It's only, the concessions only apply to the employer, and it's to encourage employers, of course, to put people on apprenticeships and to encourage them to take on younger people. So essentially we have a contribution threshold for secondary class 1. Again, this is on your tax table, it's shown on the screen in front of you, and you will pay at the employer rate on the wages above the contribution threshold, which is known as a secondary contribution threshold. Most companies do have a employer allowance available to them. Tends not to be tested in the exam, this. The current amount is shown on the slide in front of you. Essentially, this can be applied as a credit against your overall secondary class 1 NIC bill. And so if you actually are below the employer allowance, or your due contributions are lower than the annual allowance, then you will not pay that. Quite basically, will not pay it. Secondary class 1 is a deductible expense for companies or businesses' profits as well. So like paying a salary and you can deduct that, you can deduct essentially any contributions that you make to a DWP through the NIC system. So the next class we're going to look at is Class 1A, which only applies to employers and only applies to benefits in kind. So where employees are provided with taxable benefit in kinds, P11D benefits, as we looked at in the income tax section, then essentially what is happening is the revenue will say, well, we can see what's happened here. You're paying this person a lower salary, you're giving them a nice shiny car, and as such you will have to essentially pay less Class 1 NICs. That is replaced essentially by Class 1A. So that's the whole purpose of Class 1A. It's paid purely by employers on the benefit of the taxable value of the car or the benefits in kind. You pay it at a flat rate of tax based on that, which is the employer's rate of NICs. So it's important you remember that it's not paid by employees, and you cannot use your employer allowance against Class 1A if you are essentially needing to pay this. So an important part of the broader NIC class regime.